December 26th, 2024. Obviously, it's getting towards the end of the year, and so there's only a couple of trading days left. And a lot of times on the back half of Christmas, between Christmas and New Year's, since there's a day off for New Year's, the trading gets a little bit quiet. And it wasn't super quiet today. It was all right, but it was definitely a little bit quiet, especially in the back half of the day. So we're starting out the day with a gap down, and the thing you have to notice is that we've been in a multi-day bull trend. So we started on Monday, and we had a bull trend most of the day Monday, and the half day on Tuesday was a bull trend as well. So coming into Thursday, you know that we're probably not going to get a big bull trend today, considering the fact that we've had consecutive bull trend days. So the odds of another big bull trend day go down. We're probably not going to get a big bear trend day either because there's too much buying pressure from the past couple of days. So the odds favor a trading range during the day. Bar one, a bull bar, a large tail. It's a trend line break from the entire prior day. So we have, a sort of bull trend line. And we're getting a break on the gap down. And bar one, a bull bar failing at the moving average. Two, an inside bar. So we have an inside bar on two. Low one short, probably buyers below, probably sellers above. Another inside bar on three. So we have consecutive inside bars, 2 and 3. And again, I'm expecting sellers above, and I'm probably expecting buyers below as well. It's really not great to buy above 3 because you know that the bears are going to get a second leg down. Or sorry, that the bears, the bears are going to get a second leg down from the gap. And quite frankly, you're buying right on a flat moving average and you're buying above a bear bar. And it's tough to want to sell below 4 because you're selling a tight trading range. It is a double top 2-4, so you probably could sell below 4, but it's really, I would just rather wait. Swing trades aren't all that good here. 5 is a huge bear bar, but it's a giant sell climax, and you really don't want to sell at the close of bar 5 because the bears need one more bar. If 6 is another bear bar, then that'll prove to traders that the bears are able to get follow through, because if there's any bear follow through for bar 5, it means that the bears were interested in selling the close of 5. If you're selling 5, you're selling against, again, a multiple day bull trend. So you probably have to be expecting more trading range price action, which means there probably should be traders buying around this low. And that's probably what's causing the big bounce on bar 6, a large bull bar, is all the traders buying around the bar 5 close. What are the bulls doing on bar 5? Why are the bulls buying? Well, they know that it's probably not a big, strong breakout, and it's probably just a climactic vacuum test. So what they're going to do is they're going to buy the close of 5, and if 6 is a bear bar, they'll just get out below the bear bar. And instead, you can see they're able to make 10 points pretty quickly. And then a lot of them will scalp out. Do you buy above 6? I don't know. It's a big enough breakout that you know it's going to get a second leg up. So you could buy, or you could wait for the second leg to start and then look to get in on that. 7 consecutive bull bars, good for the bulls. 6 and 7, but 7 obviously a much smaller bar. We're probably going to have to go sideways before we go much higher. Outside down, bar 8. Do you sell below 8? I probably wouldn't, but if you do, or if you were looking to sell below 8 on 9, what was your calibrated expectation for 9? What did you want bar 9 to look like? Well, I think if you sold below 8, you need pretty much a collapse because 6 and 7 are pretty strong. And if you're looking for a second leg from 4 and 5, you're going to pretty much need a collapse on bar 9. And instead, you get an inside bar. For me, that shows a lack of conviction on the bears' parts. If I was going to sell or take a short below 8, I would want the market to pretty much collapse in my direction. And instead, we get a bull bar, and the sell below 8 doesn't even trigger. So not really worth selling. Traders who sold the close of 8 trapped on 9, using 10 to buy back their shorts. So a lot of traders buying back their shorts on 10, and that's what's causing the bounce on 11. Bull bar closing, on its high or near its high on 11. If you had bought above 6 or 7, how do you feel about 11? You probably feel good. You're thinking, oh, okay, if the trade is going to work, it's probably going to start to bounce right now. And so that's why it's okay to buy above 11, because if the trade is going to work, it's probably going to start to bounce above bar 11. So traders will take the buy, hoping for at least a second leg up. 12 consecutive bull bars. So okay to be holding after you bought above 11. 13, another bull bar. Good for the bulls, probably going at least a little bit higher. But decreasing body size 12 and 13, and we need to break out above this high. However, I still think this whole rally probably needs a second leg, so we're probably going to get at least one tick above this high. I did think also, during the day that we would end up getting one tick back above this high after all of this sideways. I did really, this morning I did really well, and I gave a lot of it back, specifically in here. Today I bought the close of 11. I added more right here during 15, around the 10 high. My logic was if 15 closes on its low, I'll just exit below 15. And then I exited here, and then I bought it back here, and then I exited here, and then I bought again here, and then I exited here. So I was pretty much This trade was flat, and I had two pretty good wins coming into the afternoon. And then I bought as 41 was selling off. So I bought basically the low tick of 41, and I scalped out at the 37 low during 42. Didn't quite get there, but I got close. And then, so I was up pretty good, obviously, early in the day. And then I ended up buying as I basically bought as 45 was pulling back and bought more on the close of 45, stopped below. And I added as 46 was bouncing. And then I ended up getting stopped out on 49. And that was actually, I took a slightly bigger position size than I probably should have. And then I bought the close of 63. And I bought as 69 was selling off. And obviously, it closed a lot stronger than I wanted to. So I just put a stop to exit here. And I ended up getting out over here. So I took a very small loss on that. But I gave back like half my profit on the day on this trade because I think I just traded a little too large. But I had a couple of decent. I think that's everything. I bought like I said, I added to it, but I had a couple of break-even trades. But anyways, 14 a bear bar, buyers below 13, and then 15 sold off. Traders buying around the 10 high during 15, and they know that if 15 closes on its low, like I mentioned, they can just exit. So when you get a good-looking bull bar on 16, the part you added is was a very low risk, and now you have a better chance of getting the high reward. If you don't want to buy during 15 and you'd rather wait, then you can take a higher probability buy and wait for 16 and buy above 16 or buy the close of 16. 17 consecutive bull bars, good for the bulls going higher. 18, another bull bar, again, good for the bulls. I bet we're going higher. 19, 4 straight bull closes, so a full 4-bar micro channel for the bulls. That's the buy the close, and you go for the measured move. So I basically front ran it when I bought down here, but I ended up getting out at the measured move, so that's why I exited up here. 20, a pullback, but really not all that great. Probably buyers below. 21, a bull bar, but a tail on the top. We might go a little bit higher, possibly 3 pushes up. 11 through 22 is possibly 3 pushes, so it's bull bar 22. And then a big bear bar closing near its low 23. But are you selling below 23? No, probably not. I mean, you'd imagine there's going to be buyers below. You exit below 23. I did exit below 23, as I said. I thought it was reasonable because it was big enough that it might need a second leg. So if you're exiting below 23, what's your calibrated expectation for that? Well, you think about the other side. If you're a bear who sold below 23, you want to see 24 collapse. You want to see it be a giant bear bar like 8 or like 5. And instead, you get a bull bar. So a lot of bulls will buy back their long above 24, expecting that even if we do go a little bit more sideways, we're not going to collapse to the downside. So we should go higher. I personally waited for the follow-through bar, higher probability 25, bought the close 25, and then follow through 26, 3 straight bull bars, and then a climactic bull bar 27, 4 straight bull bars, probably again still going higher, but 27 is climactic. 28, an inside, or not quite an inside bar, 5-bar bull micro channel, expecting a second leg up. Traders buying below 28 during 29 or buying the close of 29, and we get a good bull bar on 30, but a tail on the top. 31 consecutive bull bars, 30, 31. It's still a small pullback bull trend. This, we have 1 leg, pullback 2, pullback 3, or 1, pullback 2, pullback 3. This is probably exhaustion. This gap here is probably an exhaustion gap. It might not be, but the bulls are going to get a pretty clear bounce. The bounce is going to pretty clearly continue if it's not. 33 or 32 of a doji bar, and traders buy the close 32. 33, a bull bar, but a tail. And then 34 consecutive bull bars, 33, 34. Probably traders willing to buy not too far below and sell not too far above. 35, I think that's disappointment for the bulls. 33 and 34 is a climactic breakout above the bull channel. Mostly 34, right? You can see that we're breaking out above the high of the bull channel on 34. So bulls need pretty good follow through here if they're going to get a measured move. And instead, you get 35 disappointing. A lot of bulls exit below 35, and that's what causes 36, a big bear bar. But bulls buy the moving average, 37, a big bull bar. But 35 and 36 is going to get a second leg. So you have to expect us to get at least 1 tick below the low of 37. 38, bear bar, but probably not going that far. I think we'll get back to the close of 37 at some point. And we did. It was later in the day. I also thought, like I said, we might get back above the 34 high, but we just never got there. 39, a doji bar, probably going at least a little bit lower. And then 40, a bear surprise, a give up bar. You could have bought the close of 40, but I thought that it was a little bit too high up in the range of the bar to buy the close of 40. I wanted to buy a little bit lower. So I ended up getting long at about that price with the stop here. and a limit order to take profits at the 37 low because I thought that this gap should fill. And if the gap was going to fill, I thought we'd bounce and work within a couple of bars, and we probably would not trade below the 40 low. Why wouldn't we trade below the 40 low? Because if you're a bear who sells the close of 40, you probably a lot of the time are not going to be able to get to the 40 low because of how large the tail is. And it's a third leg down, 1, pullback 2, pullback 3. So I thought this area was primed for at least a small bounce. And if it wasn't going to bounce, then I didn't want to try and hold and take a chance. You know what I mean? So you don't necessarily want to hold these types of trades because if it starts to go against you, you might make bad decisions and try to scale in. So you just have to be a little bit quicker to get out with that. 41, an inside bar, a bull bar, probably sellers above, scaling in higher. The channel down is pretty tight. 42 bounces to around the 37 low. Disappointing tail on the top. Probably, this whole thing is starting to look like a trading range. 43, a bull bar, but a large tail. Again, 37 low, sellers. 44, consecutive bull bars. Good for the bulls. We might go a little bit higher, but looks like 2 legs up. 45, buyers below 44, but a lot of them scalp out when they get the big bull bar. 46, it's 3 legs up. 41, 44, and 46. And some traders sell the close 46, causing 47. Why do they sell the close at 46? Because it's the third leg and they don't want it to trigger above 46. Again, the channel up from 41 to 46 or 47, I suppose, was reasonably tight. So I thought it was, there's a good enough chance that we were going to get above the bar 34 high. An inside bar 47, probably sellers above, and you can see there were sellers above during 48. An outside down bar, or sorry, not an outside down bar, but a big bear bar, disappointment for the bulls, 49. We're trying to get a lower high major trend reversal. So, meaning what are the characteristics of a lower high major trend reversal? Trend line break, lower high, and potential sell-off. 50, a bull bar. So, sorry, lower high major trend reversal, but, a lot of good bull bars, and the bears are going to need to start getting good bars if this is going to work. 51, buyers below 50, and then 52, a big bull bar on 52 and 53, leading back to the 48 close. 50 did not get back to the 48 low, so I did think we were going to get back there, and we did on 53, but really hard to take these trades. 54, a bear bar, buyers below 53. 55, 56, consecutive bear bars, but a parabolic wedge on a lower time frame with all those tails. 54, 55, 56, sellers above 57. And then a low one short 57, but the bottom of a trading range. So traders more buy the close than sell it. And that's what causes 58. If you did sell below 57, your expectation was that we would collapse. And instead, we have, a bull or a doji bar. So a lot of the traders buy back their shorts at the market, causing the micro gap 60 or 59 and bull bar. 60, probably buyers below, bad low too short. You can see buyers below 61. Outside bar 61, outside bar 62. So it's an IOI pattern and an OO pattern at the same time. You can buy above 62 for a swing trade or wait for follow through confirmation 63. And then basically you're hoping that we get back to at least 37 high because it's a big bull bar. So it should get tested in a trading range, which we did end up getting to. Or you're hoping we get back to the 34 close or the new high, which we did not get to. The reason, these are buy the close bars in a bull trend, they're just really climactic. So sometimes you have to sit through a crazy, if you're buying these, you have to have a really wide stop, spike, pullback, bull channel, maybe a stop all the way at the bottom of the channel. And I'm assuming we got a 50% pullback, maybe a little deeper of the bull channel. Yeah, deeper, but around 50%. 50% was around the close of 40, and that's where we went sideways. So traders buying, we're hoping we'd get back up here. So 64, 65, 66, 67, tail 68, and a bit climactic, but still okay to be long. And then traders disappointed, sell out of their long 69. Usually it's okay if you get a pullback, but obviously you don't want a giant bear bar closing on its low. 70, a bull bar, high one buy. Some traders would take it, basically taking a chance we don't get back below 79 and that we go somewhere up here, but difficult to do. Follow through 71, 72, a low one short. Not really great to sell, probably but more buyers below. Disappointment 73. 73 could be the second leg from 69 since it was going against such a good bounce. And obviously started to go sideways. And over here, we kept trying on 173, reversed up. 74 was on its high and then sold off. 75 was on its high, sold off. 76 was on its high, sold off. And then the market went outside up 77, trying to get that breakout above and failed. And then traders give up, and that's causing 78. Ultimately, if you keep trying to get the reversal up and keep failing, traders are eventually going to give up. For trades on the day, the best stop order is probably 11. But you can buy above 6 or 7. I would not sell below 8. And if you sold the close of 8 and you found 9, or you saw 9, you'd probably be pretty disappointed in it. Look to exit at the market. 11, a bull bar. Like I said, goodbye by the close 12. 16 is pretty strong because, a lot of the bulls, like I said, will add as 15 is selling off, willing to get out below it. And it gets bought up, and then a big bull bar closing near its high. So 16 through 18, pretty strong. 25, 26, 27, strong. Well, 27 climactic, but fine. And then for stop orders, I would probably not do anything again. Realistically, nothing is all that great until 62. You can buy the close 63, 64, 65, 66. And then that would pretty much be it for me. 70 is not ideal because you wanted to buy as it was rallying, and now you have way too deep of a pullback. The daily chart. One second. Let me just pull up the Globex daily. So you can see traders, bear close here after 3 straight bull bars. So 3 bear bars and then bull close, 3 bull bars. So big down, big up, confusion. I think that, a bull who buys this close is probably going to make money because it's the first pullback and there's probably buyers below. And we should get a second leg up. So be interested. I would pay attention tomorrow to this high. The weekly chart. Oops, that's the monthly. The weekly chart. An inside bull bar. It might be an IOI pattern, inside, outside, inside pattern. We might have to get above this high, but I'm not sure how much more the bull trend has to it. But again, we'll see. And the monthly chart's coming to a close. The open of the month is 40 points away, very much within reach. So a bull close here would be important for the bulls to convince other traders that we're going higher. All right, that's going to be it for the review.